Okay, hello everybody, and welcome to Investing with IBD for October 23rd, 2019. I'm your host, Arisha Pierce, and with me in the studio today is Joe Fahmy, Managing Director of Zor Capital. Thanks for being here, Joe.
Thanks for having me, Arisha. Appreciate it.
On today's podcast, we will talk about the current markets, the psychology of investing, and then we will end the episode with 3 current stocks. So let's get into the current market. Right now, we are in an uptrend, but we have 8 distribution days on the NASDAQ and S&P. It's been a fun, no, I won't say fun, but it's been a choppy market.
Yeah.
Indexes they're still above the 50-day, but the amazing thing is the overall indexes at least are resilient. They continue to be resilient. They continue to refuse to go down as opposed to some of our stocks.
Yeah. I mean, it's resilience is the best word to describe it, because over the last few years, no matter what news is thrown at the markets, it continues to. I joke with my friends, the market goes down, just doesn't stay down. Yes. It just seems to just always bounce right back. I think overall, we're in a great environment with fundamentals are strong, interest rates. Earnings are good. Sentiment's been pretty poor. So the environment is good is equity friendly.
Yeah, and now a couple of years ago on one of your blogs, you were talking about this right before Trump got elected.
Yeah,
you made the prediction that we're still in a bull market. We're about to start a new rally. Do you see anything like that right now, or any thoughts on just maybe?
Yeah. So let's just open up the can of worms. Let's just get straight to it. One of my pet peeves is this whole 10-year bull market. I think it's bullshit.
Yeah.
I think people, it's the stupidest definition that the S&P has to correct 20%, because in 2011 we had a 21% correction, but closing it was like 19.8 or something.
Right.
It's so dumb.
Yeah.
And then from mid-2015 to mid-2016, I don't care what anyone calls it, that was a brutal bear market.
Yeah.
You had, the S&P was down like 15 or 16%, but you had small and mid caps down 27%.
Destroyed. Absolutely destroyed.
Energy down 50%. Biotech down 40%. Financials down 30%. And some of the best in the business were down 20%.
Yeah.
That's a brutal bear market.
Yeah.
And then the third one is the fourth quarter of 2018. Where that was a bear market.
Yep.
The problem is people think that a bear market has to be 08, 09. It has to be a disaster where everyone loses half their money, everyone loses their job and jumps out the window. It doesn't have to be that brutal. The average bear market, 6 to 9 months, 27% correction. That's average. Some of them are a little bit longer, like we had in 08, 09. And some of them, like we had last year, could be 3 months. Similar to summer of 98 with long-term capital, Russian debt crisis.
Yep.
It was around the beginning when I started invest. That was a 3-month bear market.
Right.
So
and another brutal bear market.
Yeah, and we had the same in the fourth quarter of 2018. So this whole 10-year bull market is nonsense. We've had 3 bear markets within the whole secular trend.
Right.
And on top of it, when you really look at the major averages, they haven't gone anywhere for 13 to 21 months.
Yep.
So the S&P and the NASDAQ are roughly the same as where they were in September of 2018. So it's about 13 months of maybe a little bit 1% higher.
Right.
So they really haven't. So this whole nonsense of we're going up every day, we never go down, this is just going to end any day now.
Right.
What's going to end? I mean, we haven't gone anywhere.
Yeah,
the Dow is 100 or 200 points above January of 2018. Which it also made a big move from, let's say, whatever it was, like 18,000 to 26,000 roughly. And similar to after a stock or after an index makes a big move, it needs to digest. It needs to consolidate.
Yep.
So we had a huge move, and we've been in a range for 21 months on the Dow.
Yeah, and so those are the indexes. But where some stocks have gone over the last few months have been down.
Yes.
For the leading cloud stocks or these growth stocks, they have gotten hammered over the last few months. And even this past week, they just kept going down, kept getting hit.
Yes, yeah. That's the challenge with the market right now is the averages. My theory is the averages are holding up because of sector rotation. Mm-hmm. So this is sort of a theory I've come up with where, not come up with it, but about 10 years ago, you could sell a stock and then it would sit in cash and you could earn 4, 5, 6% not that long ago.
Yeah.
Now, when your money moves to cash or a money market reserve, you get like 10 cents in interest, so you don't get anything. So my theory is these money managers are saying, well, instead of having it earn nothing, let's rotate into utilities, let's rotate into energy, let's rotate into financials. So that keeps the indices propped up, but these growth stocks beneath the surface recently have just, they're down 30 to 60% off their highs.
Yeah, and you mentioned 2015, 2016. That time frame reminds me of what's going on right now. I call that time frame. You called it a brutal bear market.
Yeah.
I called it the stealth bear market.
Yes, yeah.
Where
True. It's a better term. Yeah.
It's like people weren't really following our strategy or looking for growth stocks. And like, oh, the markets are okay, but the ones who are following our kind of stocks are like, oh my God, I can't believe how hard stocks are getting hit. Same thing right now.
It's interesting you bring that up because I've found from backtesting and looking, I do a lot of post-analysis of my work, I find that the O'Neill stuff and active managers correlate a lot more with the Russell and with the S&P Mid-Cap 400. We talked about those three major indices, the Dow, NASDAQ, and S&P, but go look at the Russell IWM or look at the S&P 400 Mid-Cap MDY. Yep. And they have been in bear markets for a long time. They're not near their highs, and I have found that it's especially the Russell is an indicator of risk appetite. So if the Russell's doing well, that means money managers are putting money to work in risk, in growth, in breakouts, and that hasn't worked for a long time now.
Yeah. Speculation.
Exactly.
That's when the speculation is on.
Yeah.
At that point. Okay, Joe. So since speculation clearly is not on right now with the Russell struggling, so given this type of environment, what should investors be doing right now?
Yeah, it's important to be, usually they correlate. So when the markets are breaking down, the stocks are breaking down, but this is a different market where the averages are holding up better than a lot of the growth stocks. So I think it's important to be super patient. You have to definitely keep smaller positions, maybe test some positions to see if they start to work out. Because if you notice, breakouts aren't working out for the most part. They're going and they're failing hard.
Yes.
So I think there's either you watch them or you take a smaller position than normal to sort of put your toe in the water and see if they start to work out. Because eventually, if this is sort of it might be a late 2016 scenario where the Dow kept going up but growth stocks weren't working. Eventually, growth stocks will work, but it's important to be super patient. Keep your stops in place because some of these, like you mentioned, the cloud stocks, some of them, keep in mind they've gone up 300, 400, 500%. So if they're down, they could take some time. You have to give them time to form proper bases. Keep your stops in place. And one other way I'm adapting is maybe own a little bit more of the index until the growth stock starts setting up again. And then when more growth stocks set up, you can maybe reduce the index and move more into stocks.
Perfect.
Yeah.
So Joe, let's get into how you got started. Now, you made an interesting choice, kind of like me. You went at Tufts University.
Yeah, Jumbo here.
Yeah, a fellow Jumbo. You graduated in 1995. I actually do. You look familiar. I remember you back on campus back then.
I had more hair. I had a big afro back then.
And you were also one of those, also one of the big men on campus there. You were one of the superstars on campus, right there. But it was really funny that when I saw you on Twitter and when you came and visited us, that I was like, okay, that you ended up kind of in the same space that I'm in, right? You kind of ended up going.
I think
for
it just
stocks.
Goes to show it doesn't matter what you major in college. Very, very few people use that.
It's true. And what did you major in college?
In economics and religion.
Which is a very tough type of. And I did bio, so yeah.
I know, and here we are talking markets. Yeah.
Right. So how did you get started? So after Tufts, or what got you interested in, during Tufts even? What got you interested in the stock market?
Yeah, I was always interested in the markets, and my dad kind of got me interested in a couple of stocks. I remember my first couple buys were Sara Lee and Gillette, which Gillette got bought out I think by Procter & Gamble, and Sara Lee's no longer. But my point is, like, I just bought a few shares, whatever I could afford at the time. I was just fascinated, and it was sort of buy and hold and all that. And then after college, I went to work for a software reseller, one of those big catalogs that had all the different software.
Yeah.
And I remember there was huge demand for certain products.
Yeah.
And I was just fascinated in the market, so I'd go look up, and the stocks were going through the roof.
And do you remember any of those
I remember iOmega was one of them.
iOmega, the zip drive.
Exactly. And the stock went up like thousands of percent because we were always sold out.
Yeah.
It was a joke in the call center, like, oh, someone else calling, we're back ordered, sorry. Microsoft, people were into, maybe at the time Windows 95, but Visual Basic and C++
That's
and all that.
That's right, because the whole .com was starting.
Yes.
So Visual Basic makes
SQL Server, all that stuff, and for databases. So I was so fascinated because I would notice the products. There was a definite, it kind of relates to products and earnings and sales growth and all that. When you have a new product that usually correlates to a stock doing well, and some of the products were super hot, and I just got involved in just really fascinated in the markets because I would see the correlation between their sales and how how they went up. And then I went to work for a firm in New York, and then just learned a lot and went off on my own. I've been kind of just trading on my own and managing money on my own since then.
And so you're managing money, and then things started to change even a little bit more, or maybe get a little bit more exciting for you when social media really started to take off.
Yeah, that was a different, I had actually been sending notes, emailed notes to a lot of my friends.
Okay.
That maybe 20, 30 friends that I traded with, and just, mutual friends, whatever. And I got introduced to Howard Lindzen.
Yeah. Okay.
And I sent him my notes, and he said, "You've been blogging this whole time. You just don't realize you've been blogging."
That's interesting.
So he said, buy your, I actually recommend that to everyone if you can. Buy your name. Like I bought Joe Fahmy, Joseph Fahmy.
Yes.
Like buy your name if you can.
Yeah.
Or if you have to throw middle initial or whatever, if you have a common name. But buy your name. And he said, take your notes that you've been emailing him and put them on a blog, and did that through StockTwitch. So that actually really helped to get my name out there and get my thoughts out there. And I've been doing videos for, 8-10 years now on the sites and so forth. So I guess I had been blogging for a long time, but I just didn't organize it on an actual blog. It was all done through email until my blog opened up.
Right. And then you started getting that popularity, and then you kind of took a next step further by meeting some people and joining a firm, right?
Yeah. My friend Frank Zarilla, I met him at a StockTwitch meetup, and he had the structure in place, because a lot of people said, okay, we like your ideas, we like your thoughts, or, I have an old IRA, or I'm interested in managing money.
Yeah.
So I connected with him, and we have a small RA in New York, New York-based RA, where we manage money into individual accounts for people.
It's pretty incredible, just the evolution, especially, and you're not the only one who's kind of experienced this story with social media and people getting their knowledge out there. All of a sudden, you have the stars just come through, and they get a larger, different platform. Yeah.
You develop a presence, and I think people, after a while, I always say through social media, they get an idea of, if you're genuine, if you're good, if you're trying to do, I'm trying to do my best for clients and put some good information out there. And I think people pick up on that for people who are like genuinely doing good things. And there are some great writers out there. And then when people pick up on that, they say, hey, can you help with managing money, whether it's active or passive? There's a lot of different people doing that.
Yeah, perfect. So the indices continue to hang in there, but a lot of former great growth stocks continue to struggle. Let's take a quick break, but when we return, we're going to talk about the importance of investor psychology. Stay tuned.
Hey everyone, it's Alyssa Corum with Investors Business Daily here, and I want to tell you all about our new series, Investing Strategies with IBD at NASDAQ, where we're coming to you each week from the NASDAQ market site in Times Square. Our show is all about helping investors make smarter decisions with their money by providing actionable insights. We'll analyze current market conditions through IBD's proven market timing perspective. We'll have analysts sharing the inside scoop on the hottest growth stocks from top performing sectors. We'll walk you through the best tactics for buying and selling top stocks and ETFs to give you an edge with your investments. And we'll get the latest strategic insights from trending companies straight from the executives themselves. Investing Strategies starts now.
Joe Fahmy is our guest on Investing with IBD. Okay, Joe, let's get into investor psychology and the importance of getting your head straight before investing in the markets.
Yeah, I think that is something that is not talked about enough. I think having the right process and the right strategy is maybe 20% of it, and 80% of it's psychology. Mm-hmm. I went to a conference recently, I was telling you earlier about Traders for a Cause, and I noticed there was a lot of talks about technicals, fundamentals. It was a great conference, but the talks about psychology were the ones that no one wanted to leave. People were hanging on to every word. They didn't want them to end. There were some psychologists that were talking, just some other traders who were talking about their experiences, because one thing no one wants to talk about, or it's not talked about enough, is because we all struggle at times. Yeah. I mean, that's just normal. But the problem is, no one, especially on social media, social media is, I like to say, is it's not who we are, it's who we want to be. And we know it's a lot of bullshit. Yeah. But the point is, no one wants to talk about. I have a love-hate relationship with social media because I love the people I've met and the information. But the thing that a lot of people hate is these people who are like, oh, just never lose money. And, some guy the other day said, oh, I buy 1,000 shares every day. I make $1 and in 250 trading days, I make $250,000 a year. And I'm like, oh, I didn't know it was that easy. I'm like, I just didn't.
I'll be like, why are you telling us?
I know.
Keep that money machine rolling.
But the reason to go, I'm digressing. The reason to go back to psychology is I think is when people struggle and they want to connect and try to have help to get through that part. Because again, it is so important to have your mind sharp, to be mentally tough, because when you trade, you're dealing with decision making, you're dealing with emotions, you're dealing with so many fears, and it's not talked about enough, because that's 80% of it.
It is.
It really is. Yeah. And I mean, I'm not a psychologist, but I can maybe talk about some things that I think help to calm your mind and keep your mind sharp. Something as simple as gratitude is something that's, I know people want to talk about charts in the markets and some, but this is actually very important, because if you take 5-10 minutes in the morning just to be grateful for whatever, you're breathing, you have a roof above your head, whatever, that puts you in a calm state of mind, so you're not making emotional decisions when you're trading. Because I don't care who you are, if you don't have 5 or 10 minutes to pause, and some people meditate, whatever helps, to put yourself in a calm state of mind before the trading day, you definitely have at least 10 things you can be grateful for.
Right.
Because one great thing I've learned is the mind is incapable of being grateful and angry at the same time.
I like that. Yeah.
Yeah. So when you're gratitude, you're not saying, "Oh, I hate this person." You're not. It's impossible.
Right.
So my point is, for trading, how this relates to trading is, when you're in a great state of mind, it's really going to help you from dealing with that anger and frustrations when you're trading, and the emotions that we deal with, the ups and downs.
Yeah. Now, one thing that a lot of people have to go through, and I definitely had to go through this plenty of times, is when you get hit in the markets, or those first few years are really tough. You're not making a lot of progress. Yeah. A lot of people are going, "Why are you bothering with this?" But picking yourself up, especially after you go through a correction, or you have a number of losing trades, and you've given back a lot of profits, or you're down, down big or something like that. Picking yourself up, and trying to get back going, getting that motivation going. How do you handle
mental toughness just involves a lot of discipline and a lot of consistency. Yeah. Not just the gratitude, but I mean, even like working out is a simple thing. I know I'm a big fan of Tony Robbins, and he says, people pay me 7 figures to coach them. I'm going to tell you for free, the first thing I tell them, get your ass in shape. Yeah. That's what he tells them. He's like, I don't care if you're already an athlete. Yeah. I don't care if you're a trader, if you're whatever you do for a living. You have that mental toughness by, and again, I struggle with it. I try my best, but I'm really good at giving advice. I'm not the best at following it. So I'll tell you what to do. I won't necessarily do it. But the point is that, by keeping yourself into shape, even if you do a walk or 3 times a week, whatever, that actually helps with what you said, picking yourself up and, with that resilience. Now, another thing is reading. Another thing is feeding your mind with strong ideas.
Well, with the right stuff, though.
Yes, of course. Yeah. You don't want to read like,
Twitter.
Yeah. I think it's not just the great investment books, but it's a lot of the self-help books. Yeah. There's a lot of audio books, podcasts, like great ones like this one.
There you go. I like that.
There's a lot of, I'm a big, like I mentioned, Tony Robbins, even if it's the spiritual stuff. YouTube is just an amazing resource. I mean, like David Goggins, I'm a huge fan of.
It's so funny. Everyone's a fan of David
Goggins.
How
can you not be? It's one of the greatest life transformation stories. Yeah. Because if you I think of mental toughness, I think of someone who is, it's impossible to watch one of his YouTube videos and not want to break through a wall.
Seriously.
Mean, within 10 minutes, you are just so fired up, because he's not, what I love about him is he's telling a story, but he's not saying you have to do this or imposing his beliefs or ideas. He's just saying, this is what I did, and this is what I do, and it's the consistency, it's the discipline to, again, the gratitude, the workouts, the reading, the feeding your mind, like you said, with good ideas, great ideas, to keep yourself sharp. And then one last thing I'll add is who you surround yourself with. Yep. They say you become like the 5 closest people you surround yourself with. So if your significant other is smoking, you might be smoking. Right. If your significant other goes out to work out, you're probably working out. Right. If they're a crackhead, guess what? You're probably a crackhead. So we can edit that out. But anyways, but the point is that who you surround yourself with, to be around great, positive people who are supportive, who are going to pick you up, and who are also going to challenge you a little bit too. Right. So that's all part of, and some people will say, yeah, great, make me a bicycle clown. I want to look at charts. Like, they don't really care. But the point is, like,
that person's probably most likely in New York, right?
Exactly. And I get called that all the time. But the point is, nothing will work. You can have the greatest system in the world. I can hand you a great setup on a silver platter. If your head's not right.
Yep.
You know, I'll give you two quick examples. 2017 was an amazing year, with one of the few years where we didn't have less than a 3% correction.
Yep.
It was like an X equals Y line, markets up 20%.
Yes.
Friend of mine was down 35% that year. And you know why? He was going through a brutal divorce.
Oh,
so his head
sense.
wasn't straight.
Yeah.
And he hated the market, and he shorted it, and he was so angry. He wasn't angry at the market. You know, we all have different things going on in your life. If you don't have that in check, and you don't have that mental toughness and have that, then you shouldn't be trading, or you shouldn't be attacking the market without that clear head.
Yeah.
You know, so that's one example. Another example is a sports example with golf. A few years ago, the #1 player on the PGA Tour, his average score was 69.5 for the #1 average score for the whole PGA season. You want to take a guess what 50 was? The 50th? 70.2.
It's that.
Less than one stroke.
That
Less
is
than one stroke. The #1 person outside of endorsements, I think, made $12 million in prize money, and the 50th, I think they gave him a box of Titleist or whatever. I don't know. Made like less than like a $500,000, whatever. But you're telling me between the #1 and the 50th is less than one stroke.
That's amazing.
It's not the mechanics. It's not the process. It's not the, to equate to trading. It's not the, whatever your strategy is.
Yeah.
It's all up here.
Yeah.
They can all drive the ball 300 yards and hit a 40-foot putt, but you can even see it if you're a golf fan. When they, you watch the Masters on a Sunday or whatever, you can see in their body language who's confident and who's mentally tough.
Absolutely,
you're like, they're not going to make that putt.
Well, talking about
or they will make that putt. Yeah.
Belief, right?
Yeah.
You also have to believe. You have to increase that belief in yourself, belief in what you're doing.
Yes.
And the belief that, okay, I'm going to execute this strategy. It might not work, but the only control I have is actually being there at the right time.
Yeah.
And if it works, good. If it doesn't, I cut my losses.
That's a great point, because just to have that mental fortitude to actually give it a shot. Like if I say, okay, here's a great setup, you still have to have that mental toughness to say, to click on the mouse and actually buy it.
Yeah.
And even if you start small, because you make such a great point about confidence, even if you start small and you see a little bit of success, you can build it from there. But even if you're wrong, you can cut your losses with hopefully, and maintain your portfolio.
Right. Now let's talk briefly about sentiment.
Yeah.
Because this goes into psychology, and there's a whole psychology with the market, and you can really use sentiment in your favor to the downside when the markets are coming in, when that fear is coming up, right? Yeah, and there are a number of sentiment indicators out there. Which ones do you like to look at to give you an idea?
I'm a big fan of NAIM, which is National Association of Active Investment Managers. It's roughly 0 to 100 of how invested they are. So when it gets over 90, 95, they're maybe too bullish, and when it gets below in the 50s or lower, that's a good sign of. So from a contrarian point of view. Equity put to call ratio I love, because I don't like the index one, because sometimes people will own a lot of equity, but they'll buy a lot of puts as a hedge. So that's not a directional trade.
Yeah.
But when they're specifically buying puts on individual stocks, I like to look for readings above 0.9 or higher. For example, we talked earlier about the correction, big correction or bear market, whatever you want to call it, in fall of 2018. It ended December 21st with a 1-point-something reading on the equity only, 1.1 something.
Yeah.
So that was really an off-the-charts reading. And usually when you get that above 0.9 on equity only, you're within a day or two of at least a rally or short-term low.
Yeah, and then, but usually also that time, even if you're out of the market, your psychology is probably, whoa, this market's they may never go up again.
Yeah.
You get conditioned to. It's amazing how easily, at least for me, how conditioned you get over the last few weeks. That's all I remember.
Yes.
The markets are really going down.
It's recency
hard.
bias.
Yeah, it's just hard to think that it could ever go up again. But that's where you have to kind of catch yourself, manage your mental state at that point, and then go back to that belief that, hey, these markets are going to turn around. I'm going to look for that fall through day. I'm going to look to see when these markets
that's
actually
when
have a chance,
you
and then I'm going to act.
absolutely have to be on. That's such a great point, because recency bias and you just got killed in the market, everything looks like garbage. Just to really quickly, some other sentiment measures, AAII, I look at the Investors Intelligence as well, the survey, the newsletter writers. That's not as important, though, because the put to call is what people are actually doing, but the survey writers are what they're just telling people, I'm bullish or bearish. It's not what they're actually doing. But anyways, when you have those really extreme bearish readings, you're absolutely right. That's when you should actually the word acceptance should come into mind. Accept that we're going to have bull markets and we're going to have bear markets. We're going to have uptrends, corrections, whatever you want to call them. During those downtrends, that's when you need to be ready and be fresh and say, okay, it's getting too extreme here. Keep in mind, we will have another uptrend, and that's when you need to be prepared, because around end of December, if you just threw in the towel, you missed the January 4th follow-through day.
Right, exactly.
Yeah.
And we'll end with one more sentiment indicator.
Sure.
Twitter.
Twitter's a great sentiment indicator.
Briefly explain why it's a great sentiment indicator.
You know what? One of my I'll say one quick thing. When I look up a stock and no one's mentioning it, I like that.
Yes.
Because if no one's, you put in the cash tag and you put in the symbol and no one's mentioned it for a few days, that's a great thing. When you put it in and there's like 50 mentions in the last hour, that means everyone's watching the same stock.
Yeah, and it's almost a herd mentality, and those can never work almost.
So you can use that from a contrarian point of view. I mean, I love the George Carlin quote, think of how dumb the average person is. Now think half the world's dumber than that. It's like hilarious and sad at the same time, but the average person's an idiot. And that's why I pay attention to sentiment, because if the average person's, pretty dumb, then half the world's dumber than that. You kind of want to know what everyone's thinking. And I'm not saying I'm smart. I just want to know, I want to make sure I'm not thinking like everyone else.
You want to be on the right side of that.
Yeah.
So managing our mental capital in the market is essential for success. Coming up next, Joe and I will talk about 3 current stocks in this market. We'll be back. Hey guys, if you really enjoy listening to the podcast every week, we'd love it if you could rate and review the show on iTunes. Your review and ratings really help out the show, and we would love to get your feedback. Thanks so much for listening. We are back with Joe Fahmy. Okay, Joe, let's get into some current stocks in this market. And the first one is one that I don't know if a lot of people have heard about, Joe. Google.
Do you need the symbol?
Yes, exactly. Google here. So right now, it's forming a base, which is pretty amazing in this kind of market, right? And it's a tech stock, too. A lot of tech stocks haven't been doing that well. But it's forming a really large cup with handle right here. They're reporting earnings in 5 days.
Yeah.
What do you see in this stock?
Well, we talked earlier about how a lot of the major averages have been consolidating for a while. When you look at some of the FANG stocks or some of the big caps, they've also been doing the same. Google's been whatever it is, 13 months, something like that, base 16 months, something like that.
Yeah, almost like that. Yeah, exactly.
Like the markets. Yeah. I mean, I consider it like an ETF, basically. They're involved in so much stuff now. It's not just search and Google Ventures and so many other things. But so it makes sense that it's correlating to the markets. But, one of the points I want to stress is not only is it a big consolidation, but they're earning an insane amount of money. So you have that institutional support where this is a growth and a value stock. Mm-hmm. Part of the reason I picked it is because, as far as we talked about right now in growth stocks, there's not that many great setups, but I do like the bigger base. I think you're always going to have that institutional support from both growth and value managers. But one thing, because I started investing, mid to late 90s, where there were so many of these .coms and so many companies where they made no money. They were trading on eyeballs, they were trading on clicks, and so all sorts of ridiculous measures. And even the ones that did well would be, 2 cents versus a loss of 1, or 1 cent versus a loss of 3. These guys are earning over $50 a share.
That's amazing. So
that's what I mean by some of the, when people say overvalued, or they, these companies like Google and Priceline are now booking, but all these companies, Apple and so forth, they're making an insane amount of money. You're talking between 50 to 300 billion in the bank, Microsoft, all these big caps. So it's something when people say, oh, this is a bubble or this and that, the difference now between back then is these companies are not only huge conglomerates, but like their balance sheets, their financials and fundamentals are incredibly, incredibly stable. They're making an insane amount of money.
Yeah, and you mentioned earlier, they have their hands in a lot of different things.
Yeah.
Now, one thing obviously is the cloud. Obviously Amazon's the leader there, but Google very rapidly grabbed some of that market share.
Correct.
And these guys, they also have self-driving cars. That could potentially eventually become another huge business for them.
Yeah, that and Google Ventures is something very few people talk about. They're involved in a lot of different things. But self-driving cars is something they're very big in as well. And I just think by spreading out more than just search, it kind of gives them diversification. That's why I joke it's kind of like an ETF because they're involved in so many different businesses.
And they also own the second largest search behind Google.com, right? With YouTube. I think that's the second.
True. Yeah,
second
that was
largest.
one of the that's got to be one of the top 5 acquisitions of all time.
Right.
And granted, they embedded YouTube into Google to help it. I mean, what was it, like 1.6 billion? They say it's worth 40 billion or something on its own, which is greater than so many S&P companies. But if the markets are to move out of this range and we're in a good interest-friendly environment and so forth, and we are going to propel higher, I can't see the market going up without Google because they've all been consolidating, and I could see this one going higher, over the next year or two.
Yeah, I pulled Google up on a monthly chart, and it's building this really big, large cup with handle there too.
Yeah,
and it's just been a nice, steady trend. Kind of like the market, it's just slowly keeps growing.
And we talked about earlier, whenever a stock or an index makes a big move, it's normal for it to consolidate. Right. And it made a huge move back in, I think, 16 into 17. So this sort of whatever year and a half long base makes sense that it's been consolidating. And again, if the markets cooperate, I could see this one going higher.
Perfect. Let's go to the second stock, and this is an oldie from 2016, 2017, but still a goodie, at least on a fundamental and expectation levels. Nvidia, ticker symbol NVDA. And now these guys, they're on a technical level not as constructed right now. You mentioned big moves. Nvidia had a super large move in 2016 and then also a pretty solid move in 2017. And now maybe they're consolidating that move. Maybe they're building large base or maybe not. But what do you see with these guys?
Yeah, I think as far as the chip leader, it used to be Intel and it's now NVIDIA as far as the world shifting from CPUs to GPUs with. And again, you mentioned so many different things that Google's involved with, but their chips are not just AI and machine learning and obviously PCs and gaming and so forth, but also driverless cars. Yep. They recently did a 5G contract with some. So they're involved in basically everything the world, Jeff Bezos talks about all these things being the future. Everything, all those different, I know they're all great buzzwords, but everything that's involved with that, NVIDIA's chips are involved with everything the world is moving forward to. So one lesson I will say real quick from the past when it did go from 20 to 60, and I remember asking a friend who was involved in tech, and he said this thing is going much higher. So the lesson there is just when you think something can't go higher, it usually does.
Right.
Same on the downside in a bear market. When
you
think something doesn't go lower, it usually does. But I remember it went from 20 to 60, and I traded a couple times, and a friend is like, this is just in the infancy stages. And then it went to from 60 to 300. So the lesson there is, if you can get into something early and you have the patience, depending on your time frame, and you can ride some of those trends. I remember it made a big, huge base around 100 and then took off and went from 100 to 300. So moves in the markets can go on longer than we expect. Now, obviously, I think part of the reason is the liquid stocks were being sold off in the fourth quarter of 18, and Nvidia and Amazon, some of the big ones were like that. But I think they're, and their earnings slowed down a little bit, but still earning over $7, $8 in the next couple of years. I think the valuation's reasonable, and I think just being involved in so many amazing, industries and verticals, I think they're going to do well.
Yeah, it's always one that you should have on your radar. At least it might not be actionable at this point, or maybe not for a while, but it's at least it gives you an idea of if those type of stocks are back in favor.
Yes.
Right? Just the larger semiconductor stock, semiconductor
When
stocks.
semis do well, it's usually because the markets and industry is doing well, as semis pretty much go into everything, from appliances to everything.
Right, and that's almost another form of speculation right there, or a form of how well the economy is doing when the semis are doing well.
Exactly,
right?
Yeah.
Let's go to the third and final stock here, and this is Intuitive Surgical. And now Intuitive Surgical, obviously these guys have been a game-changing company for many, many years. They reported earnings last week, and they had a nice earnings gap that, like a lot of other earnings gaps so far,
gave it up.
Immediately sold off. So it kind of came back, filled in the gap, but it's still hanging in there. And they've been building a large kind of consolidation here. And it looks like it's just going through that process of just building a consolidation, kind of maybe exchanging those shares from weak hands to strong hands. So
yeah. No, this is also a play not only on medical devices, but also on AI. I think in one of the AI ETFs, it's one of the biggest holdings in there.
Oh, interesting.
Yeah, so it's And again, same thing as I mentioned before, after a huge move that it made from, again, whatever it was, 200 to 500, 600, whatever it was, and then it just went sideways, similar to the markets. I mentioned earlier this week that it's consolidating after the big earnings. It could still continue to consolidate for a little while.
Yeah.
So I just want to stress the point. It might not be actionable, today is a point, but these are just sort of, these three stocks are, that I still think have good growth prospects and great earnings behind them, because as we know, what drives big winners and what drives stocks is earnings and sales growth. And it's what's amazing about some of these companies is how big they are, and they're still growing earnings and sales at double-digit rates, for even like a Google or Intuitive Surgical, 20, some 15, 20, 30%. It's impressive for companies that large.
Yeah, and that was almost the normal. When these when companies in the past would get up this large, they can't really grow anymore. But it seems like some of these companies, and Amazon's a great example, they're kind of defying the odds. Maybe things are shifting a little bit, or maybe these companies are just so powerful and they have so much data and they can just pinpoint their customers so well these days that they've really gotten the selling down to a science.
Yeah, I think it's, that's why they talk about government wanting to break some of these up, because they're too big. That is one risk you run into. But as far as it's impressive when you do talk about the FANGs, and even outside of the FANGs, some of the big financials, some of the payment processors and so forth, they continue to grow as a lot of them are still expanding internationally.
Yes.
So there's still that revenue coming in. Sometimes when people say, I don't want to get, if you're involved in S&P companies and I need international exposure, I say you don't need international, because whatever, like 40, 50% of the revenues are coming from international, and they continue to grow. It used to be 20, now it's closer to 45 or something. But these companies have enough international exposure and continue to expand in emerging markets that I think it gives you good diversification as far as the earnings just keep coming in.
Yeah, excellent. So there are three stocks to consider during this uptrend, and at least to keep in your watch list and buy them when the markets are better uptrending and when they are more powerful breakouts. So remember, the most important thing, though, is to manage your risk, and as we spoke about in segment 2, manage your mental capital. Thanks, Joe, for joining us today.
Thanks for having me. A lot of fun.
That's it for this week on Investing with IBD. Next week, we are going to have Bruce Frazier on the show. Bruce is a longtime professor of Golden Gate University and an expert on one of the pioneers of technical analysis, Richard Wyckoff. And Bruce has spent 3 decades investing using the Wyckoff method, and he's going to come on the show and give us some great insight on the market. So we're looking forward to that. So that's it. I'm Arusha Pierce, and thanks for listening. And for this week's notes and charts, make sure to go to investors.com/podcast, where you'll find details for each episode in the podcast episode section. And make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.